to bring inflation down reliably?
Well, I think that's the big question. Is this the appropriate terminal level? Or with the Fed hyper-focused on achieving that soft landing, did they fall short of achieving that sufficiently restrictive level in order to control inflation? Well, as you know, we were long standing that the Fed needed to raise rates up to 6% and perhaps higher if we continued to see inflation behave in an unruly manner. So I do think that the Fed was so focused on trying to achieve this delicate balance that the Fed historically does not have a great track record in achieving, that they did stop short. And unfortunately now what we're left with is inflation reversing course, still double what the Fed's 2% target is. And the committee now is losing, I think, a lot of credibility in the marketplace by sitting on the sideline, not reacting to 3 consecutive months of inflation reversing course.
It's notable. We're talking credibility again. Lindsay, is there a path that you see where the next move could actually be a hike instead of a cut?
Well, I think if inflation remains at these levels, with the core leveling off at about 4%, I do think that the base case is for the Fed still likely to give us 1 or 2 rate cuts. This is a committee, after all, desperate to provide relief. But without more meaningful improvement in inflation after 1 or maybe 2 rate cuts in the second half of the year, I would expect a second round pause, a prolonged pause. That being said, if inflation does continue to gain momentum, so now we're talking about the core pushing above 4%, I think in this scenario, the Fed may be willing to re-engage with 1 or 2 additional rate hikes, but it would have to be a meaningful increase and on a sustained basis.
How about that, Steve Liesman, if I can turn back to you? We're in, I guess, what you would call that higher for longer phase, but Lindsay is addressing the question of maybe we didn't go high enough.
I want to just address something Lindsay said, and Lindsay is my friend, so hopefully this doesn't come on too strong. But Lindsay, how can the Fed lose credibility in a market that itself has no credibility when it comes to predicting the Fed? The market took off and decided there were 6 rate cuts coming from absolutely nothing said by the Federal Reserve. The Federal Reserve, I think, stuck to its guns amid that kind of essentially strong pricing the other way by the market, and went back down to 3 rate cuts, and now they're back down to 2. So I don't think the market has any particular monopoly on the truth or credibility when it comes to the outlook here. It's been wrong, and I think maybe the Fed is right here to kind of wade, and I guess wading is the best way to think about it, with its mark the way it is. Theoretically, the Federal Reserve believes it is restrictive. That's the theory. If you look at what they believe the long-run neutral rate is, even if you believe it's a little higher, they think they're exerting restraint. Maybe the problem the Fed had was not necessarily not raising high enough, but talking about cutting quick enough. I just think the market itself lacks a certain credibility when it comes to judging the Federal Reserve.
And I would agree with that. But remember, the Fed lost a tremendous amount of credibility being unfashionably late to the inflation taming party. They then, to your point, regained that credibility by pushing against the market. And the market was consistently reminded of the old adage, don't fight the Fed. But now we're in a different period. We're in a new period where inflation is rising and the Fed is twiddling its thumbs, sitting on the sideline, hoping for inflation to reverse course. And that's where I'm now concerned that they may begin to lose that credibility that they had previously established by pushing back against investors, hoping for multiple rate cuts beginning in the first quarter.
You know, Steve, they call economics the dismal science, and not without reason. But Fed policy is as much, to me, art as it is science.
I think that's right. And I am, even for a reporter on the dismal science, I guess you could call it naively upbeat on a routine basis. But in any event, it's just my general sunny disposition. It is true they do not know key elements. In fact, I was just talking to a Georgetown class about this morning, a graduate class, where I was lecturing and saying, look, this is not rocket science, Tyler. It's actually harder because you can send a rocket to the moon and you know how far the moon is, you know the speed of the rocket. But if you want to know what is the neutral interest rate, that is essentially the one that will keep the economy from accelerating at a pace that is not inflationary, You only know that after you've essentially passed the moon. It's only know you've gotten there. You don't know the speed of the rocket. You don't know how fast it can travel, how fast it should travel. And you know what, Tyler? You don't even know how far the moon is. But if you talk about rocket science, we have a precise number on that. The Fed is feeling its way into this, and it needs to be very careful and I think humble here.
Great metaphor.
What's so interesting right now is we have this interesting debate between the scientists who think, you know what, we need to slow this rocket down a little bit more, and the other folks who say, you know what, we're okay, we're on the right path.
Right, and there's this idea, right, which you're referring to, Steve, is how will the economy respond? Could it overheat? And Lindsay, I wonder where credibility comes into play here. We've got jobs data, we've got economic strength that some can say is proof that higher rates aren't actually as restrictive as many had thought, and you don't need to cut.
Absolutely. The economy accelerating beyond expectations, a still very spendy consumer, a tight labor market, maybe not as tight as it was, but still a tight labor market. This further justifies not only the Fed holding rates at the current level, but potentially underscoring the notion that the Fed could have raised rates higher. And to the point that monetary policy is so qualitative, I think that further justifies the Fed erring on the side of caution, raising rates higher than arguably they think is the bare minimum. The risk is not that the Fed raises rates too high in a cycle. They can reverse course quite quickly. The risk is always that the Fed does not raise rates high enough to get ahead of inflation and restore price stability. And I think the latter is where we find ourselves right now.
Tyler, can I just quickly apologize to rocket scientists that I did not mean to denigrate their profession or debase the fabulous work that they do?
Certainly not in the week we had a solar eclipse. I know you mean well. I'm going to ask I'm going to ask you to stick around, Steve, for just a minute. Lindsay, we're going to excuse you from class. It was nothing you said or did. We love you. We're going to let you get on with your day as we bring in Rick Santelli from Chicago. I'm told you want to react, Rick, to a couple of things you just heard. Go ahead.
Yeah, when Steve said the market is wrong, all I could think of is the only entities that aren't correct in this equation about what the Fed may or may not do, other than the fact that the Fed's track record, whether keeping rates too low too long, starting to raise them too late, or not understanding the durability of inflation, or the fact that no matter how high they raise interest rates, they're not going to be able to counteract horrible government policies that have helped fuel inflation. But the Fed Fund futures contract is misunderstood, misquoted, and every economist, I don't care how high up they are, what institution they work for, they're not correct. Fed Fund futures is not accurate beyond the next meeting and only when you get close. And if I recall, if I look now, it doesn't have one priced in for June. And even though July is well down the road, it doesn't have one priced in there either. The contract was never designed to be telling you what's going to happen meeting down the road. This is something that's grown up because the market was slow for so many years and the Fed did so little for so many years. But that is the flaw. Markets aren't wrong. That's like saying when the Fed kept interest rates too low, which was wrong, that you should have gotten more interest. It was wrong, but you didn't. The markets give you and take away whatever the closing price is. It's never wrong because you can get a check. Try getting a check out of the Fed. Oh, you can't because they're in arrears trillions of dollars. I rest my case. And the 10-year note auction today was deplorably weak. And even though it's a reopening, it does underscore that there's many traders out there paying close attention and really not listening to some of the economists' interpretation of how they read the tea leaves in a marketplace of Fed Fund futures never designed to be a crystal ball.
Steve, I would guess that you want to respond.
First thing I want to say is Rick is my favorite rocket scientist when it comes to the bond market and all things that have a yield on them. I think that's the first thing I would say. I would generally agree with him, but I didn't take my comment about the 6 rate cuts from just the Fed funds futures markets. Look at how the 2-year is priced right now at 4.90, which, by the way, is actually much more aggressive. Look at where it was priced previously. What is that telling you? That over the period of time, on a daily basis, the average of the overnight rate will be X over time. So that is telling you right now that the market sees the Fed as more restrictive over time. Before, when it was down lower, it was telling you it would be lower and there would be some cuts built in, as well as the forecast of economists. My issue is not is the market right or wrong. I don't actually think the market gets it wrong because I don't think the market. Let me just say,
the market was wrong.
Let me finish the thought though, Rick, real quick, which is
in bold letters.
Yeah, the market can price it wrong, but my interest is not that happened. It's how the Fed is communicating such that the market prices in that eventuality. That to me, actually, Rick.
Who cares?
What do you mean?
Who cares?
What do you mean? Who cares?
The Fed is guesswork. It gives fodder for many that don't really understand the market movement.
Are you out of your mind?
Traders have to live or die. Traders have to live or die by what they trade. By what they trade. You think that those guys know the future any better than anybody?
They don't, but they're trading.
Truly.
But my friend, they are certainly. They are certainly, Rick, trading.
And the emperor's been naked for a decade.
Steve,
I don't need to show you a chart,
the floor is yours, Rick. Hold, and then we'll come back to you. Go, Steve.
I don't need to show you a chart, Rick, to show that the market and your trader friends out there trade on every verb, every adjective, every period, every comma spoken by the Federal Reserve. So my question is this.
And I know traders that trade on full moons, new moons, and where Jupiter is in the sky. And they're big traders, huge hedge funds. So what does that mean?
Well, I don't know what it means, Rick, but my point is that if you're arguing that it doesn't matter what the Fed says, I think we're living in different realities. I didn't say it doesn't matter. I'm saying that when the Fed talks, it doesn't mean that they're going to get the market right. It doesn't mean that the market is going to pay attention. No, but
and here's another thing. QT, embedded in these minutes is another surrender, okay? Because the Fed understands that the Treasury is sweating bullets, that the Fed doesn't lower rates, doesn't ease the cost of servicing the debt. So now what they're doing, they're going into the QT mode. And you know what? The QT mode should exist, and it should stay, because they should be nervous that if they keep it in the 7 trillion camp, the next time we run into a problem, which is probably right around the corner, what are we going to do? Move it up to $11 trillion? Where do we draw the line?
My interest, Rick, is in getting policy right for the greatest aggregate good.
My interest is monitoring the market. It's the only reality we really have.
So my question becomes, when the market prices it wrong, how did the Fed miscommunicate or communicate?
There's no wrong pricing. There's no wrong pricing. What's wrong? Okay? Are the next two meetings showing any easing? Those are the next meeting is the only one that is a valid representation.
They did previously, and economic forecasters
and what did we
also
learn today?
priced it.
Did we learn something new today? If the Cubs get a better pitcher and staff, or if the Cubs get a new Roger Maris, does it not change their chances for a World Series?
It does.
What, are you going to be stagnant all the time? No. Come on, Steve.
You got to change. You got to change, Rick, as things go. I guess we got to go, Rick, but perhaps we'll continue this at another time.
All right, we do have to leave it there.
I think we will.
I think we will.